Welcome, everyone, to another McGowan and Sutner market update.
Today, we are absolutely thrilled to welcome Brian Mulberry. Brian is the Chief Market Strategist at Zacks Investment Management. Brian brings more than 25 years of experience in the investment management field, guiding individuals through all kinds of economic conditions, from bull markets to uncertainty and everything in between. With a background in geophysics, which brings some uniqueness to the field, Brian has a rare blend of scientific curiosity with financial insight that makes his market analysis especially sharp and grounded in real-world data. At Zacks, Brian works closely with the investment research team to decode the forces shaping our economy. From interest rates and inflation trends to global growth dynamics, he's also passionate about behavioral economics, helping investors understand not only market movements, but the human behaviors that drive them. When he's not analyzing markets or sharing his insights with clients, you can find him in Littleton, Colorado, staying active, following soccer, and taking full advantage of the Rocky Mountains with his family. Little known fact, Brian went pro in two separate sports, both in indoor soccer and he's a PGA golf professional. So guy's got all sorts of talents. We're excited to have Brian here today to talk about the economic and geopolitical landscape of 2026. What's driving the markets right now, and what investors should be watching for in the months ahead. So buckle up. This is going to be a fascinating discussion.
All right, everyone, without further ado, we'd like to welcome Brian Mulberry from Zacks Investment Strategy here with us today. And Brian, let's hop right into it. So one of the hot button items right now and on everyone's mind is Iran and oil prices. So with getting into that, with the Iran conflict introducing renewed volatility through oil markets and frankly, the entire market, how much of the recent equity weakness is fundamentally tied to energy supply disruption versus pure investor sentiment and fear-driven trading?
Thanks, Peter. It's great to be with you guys today. And I would say the answer to that question is really a domino effect, right? The immediate spike, 20, 25, 30% in oil prices has a cascading effect across the equity markets. The immediate impact is felt here at home, where we see the price at the pump, right? Gasoline over $4 a gallon, diesel's over $5 a gallon. And what tends to happen is that creates a little bit of fear of future inflation. And that's real. It's founded in the fact that the last mile of distribution of the global supply chain is still 90, 95% diesel driven. So if we see high oil costs and high energy costs persist for a long period of time, it will end up being inflationary and showing up in the cost of goods of almost anything that we buy on the store shelf. So really, we have to define what that term looks like. We were told 1 to 2 months and this will be all over. If energy prices normalize after that, then it's really not that big of a deal and the inflationary effect or the fear of it goes away. But we're still in the midst of $100 per barrel of oil. If that lasts through the summer months and we get a couple of quarters worth of higher energy costs, that's where you start to see the fears realized in the fact that it might even impact things like monetary policy, where the market was expecting rate cuts later this year. There might not be any as a result of that. And that's why you're seeing such a negative reaction in the market right now.
Yeah, that's interesting. We appreciate your take on that. We want to switch over to one other topic that we're hoping we can hit on, and that's private credit. So those are we've fielded some questions from our clients regarding private credit, but Brian, can you just give us an overview on what private credit is and why it's important in the market as well?
Yeah, absolutely. So this is just another avenue to provide more or less interest income to the general investing public, right? When we've seen interest rates at a relative low for a long period of time, again, through the COVID years, they were at zero. They went up to about 5.5%. And now we're kind of settled in at around 3.5 to 3.75 for the risk-free rate, which is what we get from the Federal Reserve. What you're finding is there's always investors looking for a better, safe money return. And on the credit markets, typically when you're clipping coupons, you're getting that safer return. So you have these kind of evolution of product development. And in the private markets, which means these are not publicly traded bonds, they are private loans that are kind of held privately. They get leverage added to them, and they can pay a substantially higher coupon rate, meaning the yield, instead of being 3.5 or 4%, now could be 8, 9, or 10%. So the appetite for these credits is out there, and it's real. And it's been realized in the fact that we've seen a couple of different types of private credit products that are showing some signs of stress. One is those products that are backed by data centers. The physical property of data centers are being lumped together in loans for the construction of those data centers, and then they get pooled into assets, kind of like what happened in 2008 with the mortgage-backed securities. They get all pooled together so that we can get more leverage and pay a higher coupon rate on that product. There's been some concerns about the valuation of those underlying collateralized loans, and that's where some of the stress has shown up. JP Morgan has moved the collateral value down about 25-30% in the loans that they participate in, and that's where some of the fears are coming from. It doesn't mean that there's contagion or that all things are bad, but it does mean it's a type of market that you want to be a little bit careful of. And the hard part is you don't really know exactly what is in your underlying portfolio. And I think that's where the emotional stress comes from, is you kind of just have to take the private equity company's word of what the value of their portfolio is. And as long as they keep paying out the dividend, then everything should be okay. But enough of this rhymes with what happened in 2008 in terms of how badly it ended that I think people are just getting concerned. And again, it's not, I think, at a place where it's red light, stop everything, but it is more yellow light cautionary of just be a little bit careful about who you get involved with in those types of products.
Yeah, it's great, Brian. I think that's a good conversation on the private credit. And moving into that next conversation and topic here is AI. A lot of people know about it. A lot of people are hearing about it these days. And quite frankly, for the last couple of years, it's been on everyone's mind. How is everyone's wondering how it's going to help society, but at the same time, a lot of people are extremely worried about how it could potentially destroy entire job sectors. How do you interpret the market's shifting tolerance towards AI in the short term and long term, and what's that impact on jobs and corporate earnings? Furthermore, are investors getting better at distinguishing hype from true value creation in this space?
Yeah, it's a great question. I think that this is the biggest 180 that you're finding in equity markets right now. When I look back over the last 3 calendar years, 2023, 2024, and 2025, anything associated with AI was all positive momentum, such that by the end of 25, we had just 10 technology names represent 40% of the market cap of the S&P 500. That's how concentrated that positive energy has gotten in just 10 stocks, right? Now we're starting to see a little bit different change. There was a research paper that came out that said AI is going to take away 80% of the white-collar jobs, and it's going to happen by 2028. Well, that's just a year and a half away. That's not super likely. So on the probability spectrum, we have to have a little bit of reality check here. Now that the market is starting to question AI, I think there is some validity to that. In other words, when we look at these companies that are spending $660 billion on growing AI infrastructure just in this year, 2026, it's right to ask the question, okay, you're spending that much money. When does that come back to your balance sheet, and will it be profitable when it comes back? So I think that's where we're starting to see some good skepticism from investors asking questions around, hey, a lot of growth, but also a lot of spending. Is that spending really going to end up in future profits? And that's one of the concerns. I think on the other side of that, the more emotional draw in terms of this dystopian view of the future that AI is going to run everything, we got to pump the brakes a little bit. And my caution would be, look at self-driving cars. They've existed for 15 years now, but they're still in very limited markets because this is truly generative AI, where you have autonomous vehicles driving on their own, making decisions on where they are, how fast they can go, and how they're going to get there in terms of a route. But they're contained mainly in a regulatory environment. There has to be enough of a safety record that's going to allow wider adoption of this technology across the globe. I think anything else when it comes to AI, and particularly generative AI, it's going to have the same type of safety track record before it gets widely adopted. So we're not really believing that AI is going to dominate everything in the next 2 years. Eventually, in the next 20 years, it will be an additive to society in that it will continue to do functions more efficiently than what humans can do right now. Does it mean it's going to wipe out everybody's job? No, I don't think so. But the type of employment might change. But we've seen that in other waves of innovation as well. Just as the internet in the late 90s didn't take away jobs, it actually expanded the job market and opportunities. And this technical innovation wave is likely to do the same thing.
Yeah, I think we can all agree that AI is one of those things where it's a little bit scary, kind of exciting, but man, I don't know what this is going to look like in a few years. So, hey, Brian, one other thing we want to chat on real quick is the midterms. Midterms are coming up soon. They're coming up in November. What are our clients? What should they be expecting from the market as we approach the election?
Absolutely. We have a long record, obviously coming up on the 250th anniversary of the country, but we can look at the last 100+ years of the stock market and kind of relate how the market reacts to different types of government. The most stable equity returns come from a divided government. When either the House and Senate are under different party control or the White House, then what you have really is just a stagnant government, right? When there's little possibility of legislation getting done, that actually means that there's stability for the stock market. In other words, things like tax rates and corporate governance aren't necessarily going to change very quickly if there's a divided government. As we come into this election, it is a non-presidential election, a midterm election, and the party that's usually in control tends to lose seats during that. As the pendulum swings one way, it tends to come back to the other way. So it wouldn't be at all surprising to see the parties change leadership in terms of the House or the Senate or both. But obviously, we still have one-party control when it comes to the executive branch. So that divided government tends to be good for the market because very little is going to change. The concern would be that there would be enough, litigation to try and change some of the laws that have been acted over the last couple of years. One of those being the One Big Beautiful Bill, which did kind of ratify and codify tax rates for a long period of time. That backdrop is really additive and positive to growth in the business sector right now. If those corporate tax rates were to change or individual tax rates were to change rapidly and suddenly, then that would obviously be a negative impact on the stock market. But overall, it's one of those things where even if the party in power changes, it tends to be okay for equity markets because, quite frankly, just not a lot is going to get done on the legislative front that would impact everyday life in the business community.
Thank you so much on behalf of myself, Matt, our entire firm, and all our clients for taking time out of your day to address some of these big questions and give us some quick hitters on some of these big concerns involved in the markets today and finance as a whole, and giving our clients some of this feedback on kind of expectations, what's going on, and give us a better understanding of everything. So we just want to say thank you. And to our clients, if you guys have any follow-up concerns or questions, please reach out to your advisors. Any of us here are happy to always talk to you, always available if you need something. And thank you guys.